Hello, everyone. I am your accounts teacher Akanksha. Welcome to our lesson on partnership accounts. Today we will learn about the adjustment for all debts are good in partnership accounts. This is part 10 of our series on adjustments, so if you haven't seen the previous lessons, please watch those as well. Please note that the adjustment will be done in a similar manner, whether you are doing admission, retirement, death or change in profit ratio question. You need not understand the adjustments separately for these chapters. Let's first understand the meaning of bad debts. Then we will understand the meaning of provision for bad debts. Finally, we will understand the adjustment of all debts are good. So what are bad debts? Let's first understand this in step-by-step manner to understand the adjustment better. A partnership firm is formed to do business and earn profits. The firm earns profits when it makes sales of either goods or services. The sales can be made either in cash or on credit. Cash sales means that the purchaser will make the payment immediately. Credit sales means that the purchaser will make the payment after some days, like for example after 2 months. When a firm makes credit sales, then this is recorded as a debtor in the books of accounts. Firm makes credit sales to many people. The sum of amount all the debtors is called sundry debtors. Some of the people who are debtors for the firm may not make the payment even after the agreed time. The firm will incur a loss due to this. In other words, the debtors have become bad and hence called bad debts. Bad debt is a loss for the firm. This is charged to the profit and loss account. It is shown on the debit side of profit and loss account. Now we have understood the meaning of bad debts. Let's move to understanding the meaning of provision for bad debts. As we have seen earlier, a firm makes sales both against cash and against credit. This is true for most types of businesses. If a business will make credit sales, then there are always high chances that there will be some debtors who will not pay money and the debt will become bad. Bad debts are inevitable for any business which makes credit sales. When a business makes credit sales, then it is expected that some percentage of debtors will become bad. Based on past experience, every business can know approximately what percentage of their debtors become bad debts. We understood that bad debts are inevitable. Next, we understand the meaning of conservatism principle in accounting, before we move to the meaning of provision for bad debts. In accounting, there is a conservatism principle. It states that all losses and expenses expected to occur in future should be accounted for in books of accounts immediately. A question arises: how to account for some expense which may happen in future? The answer is, the business will estimate the expected loss or expense that may happen, and make a provision for it in books of accounts. The conservatism principle requires accountants to remain prudent, which means cautious, while declaring the profits of the business. That is why conservatism principle is also known as prudence concept. It is due to the conservatism principle, we have to make provision for bad debts. As discussed earlier, when a business makes credit sales, then some part of debtors will become bad. This is an expected loss for the business. On conservatism basis, the business should account immediately for this expected loss. When a business account for expected bad debts likely to occur in future, then it is known as provision for bad debts. Please note that such expected loss due to bad debts may or may not happen in future. We are just accounting based on expectation and estimates. If the expected loss does not happen in future, then we will reverse the provision. Why is it called provision? Provision means to set aside funds for some purpose. Here we are setting aside funds for meeting expected bad debts in future, so it is called provision for bad debts. Journal entry for creating the provision for bad debts is: bad debts account debited and provision for bad debts account credited. Bad debts are an expense which are increasing and hence debited. Provision for bad debts is in the nature of a liability which is increasing and hence credited. At the end of the year, bad debts account, which is an expense, will be closed by transferring to profit and loss account. Provision for bad debts account, which is in the nature of a liability, will continue to be shown in the balance sheet. It remains in balance sheet till the bad debts actually happen, or else the provision for bad debts is reversed. Now that we have understood the meaning of provision for bad debts, let's come to how all debtors are good adjustments are given in the question. Let's take an example to understand this. A balance sheet will be given in the question. Balance sheet has sundry debtors 100,000 rupees on the asset side. Provision for bad debts also exists at 40,000 rupees. Provision for bad debts is subtracted from debtors to get net sundry debtors of 60,000 rupees. The additional information below the question says that all debtors are good. Next we come to understanding the adjustment. In the past, we made a provision for bad debts of 40,000 rupees which is appearing in the balance sheet. Now as per the question, all debtors are good. It means there is no need for provision for bad debts now. So we will reverse the provision created earlier. Since bad debts was a loss booked earlier, but will not happen now, so there will be a revaluation gain. Next we come to journal entry. Provision for bad debts account is to be reversed. It is in the nature of liability. Since it is reversed to there is decrease in liability. Hence provision for bad debts account gets debited. Secondly, an expected loss booked in books of accounts in some earlier financial year is now reversed. So there is revaluation gain. Revaluation account gets credited. Next we will discuss how this adjustment will be shown in revaluation account. Since there is a profit, so it will be shown on credit side of revaluation account. On the credit side of revaluation account we will write, by provision for bad debts. There will be no entry on the debit side of revaluation account. There will be no entry in partner capital account due to this adjustment. Next we will discuss how this adjustment will be shown in the balance sheet. In the balance sheet the value of provision for bad debts will become nil as it is reversed. The sundry debtors will appear in the balance sheet at its full value of 100,000 rupees. There will be no impact on the liabilities side of the balance sheet. That's all for this adjustment. Thanks for watching. Stay tuned for explanation for more partnership accounts adjustments. Have a great day ahead.